Are you thinking about investing in commercial real estate? Well, be careful because you're probably not considering the most important thing that you need to consider when investing in any deal. So what is that? When you're investing in commercial real estate, you want to consider three main things: the sponsor, the market, and the deal. And usually investors get this the other way around. They are usually looking at the deal primarily. They are very eager to invest based on the deal because obviously it makes such good sense, right? It's smack in the middle of Dallas or Austin or some major city. It sounds great and it sounds exciting. It sounds really sexy. It's like, that's what we want to be a part of. And we see ourselves, when we're limited partners, we are truly partial owners of that real estate. So it's very exciting to get involved on the ground floor, watch this project develop and evolve over the next several years and make this great return. All of that sounds really enticing. A lot of companies or real estate operators will create beautiful pitch decks and fancy slides to really entice investors. And what are they featuring on these slides? It's mostly about the deal. And so I see that a lot. And I think this is really dangerous because the most important part of real estate investing, or really any kind of investing, is going to be the sponsor. And what is the sponsor? The sponsor is the general partner. A syndication is basically a partnership between general partners and limited partners. The general partner is the main head honcho. He or she or that company is the decision maker. That means that they get to decide which property to purchase, what price to purchase at, what improvements to make, how long to hold the property, when to refinance or sell the property. All of these decisions are going to be made by the general partner. And they are also going to be in charge of structuring the deal. That means deciding what your returns are going to be. And so it's very important to get to know the sponsor. So how do we get to know the sponsor and how do we vet sponsors? This is always a really tricky part of investing because there is really no industry standard. There's no clear-cut vetting process. And I've been in the midst of all this and I've been actively trying to vet sponsors and deals for the last few years. And so even for myself, it's still a very cumbersome, complicated process. I'm working currently to establish a process to vet each deal and each sponsor because so many sponsors reach out to me over LinkedIn and social media and they want to access our investor base, which is great, except there's no way for me to process all their requests. So I'm creating a process with my attorneys and other experts so that if we do find really great deals or great sponsors, we can share them with our investor base. But in doing that, in trying to develop this process, I've been talking to lots of people. I've talked to our fund administrators, securities attorneys, other attorneys. I said, hey guys, what is your process? What do you guys actually do when you come across a real estate sponsor or a deal? What is the process? And I think it's sort of a lot like asking me, what is my process when I see a patient? You know, like I've just been doing it for so long that I don't really know the steps. I mean, it's like intuitive, right? I walk into a room and I can have a very short conversation with the patient and I have a very good sense of what's going on because I've been a physician for 20 some years. So I think it's the same thing for a lot of these real estate industry experts. They've just been in the business a really long time. They've built a lot of business relationships and contacts for years. So they only work with people that they know, and that is essentially their vetting process. And this is literally what the attorneys told me when I asked them that. I mean, these guys are a major firm. I'm paying like $7.50 an hour to get this information. I said, what do you do? What is your vetting process? And it's so interesting to me because they couldn't put it into words. So they basically said that they rely on reputation and relationships. So I said, wow, that's really very subjective. And it's great when you're that person who has been in communication with that sponsor or that real estate operator over 10, 20 years. You've built that relationship, you've really gotten to know that person. However, what about the limited partner? What are we supposed to do? How are we supposed to develop that kind of depth of relationship when we are just meeting them maybe once, maybe not even once. A lot of times these deals are pitched through webinars and you're never really meeting the sponsor in person, and you might meet their team if you're local, but otherwise you really have very little contact with this company or their members. And then you are shown lots of pretty pictures and pro formas, and you're supposed to make a decision. And it's not a small decision, right? It's like 50 grand you're wiring to some company. So it's a big deal, and I think it's a huge problem because, especially for physicians, we are in an industry where we have a lot of barriers to entry, right? We have a lot of regulation and a lot of gatekeepers. We have to obviously go to medical school and residency and take licensing exams and board exams, and then we have to credential every year with each hospital we work at. We have to provide references. We have all this stuff that we have to provide all the time to simply continue to work where we work. And so it's very foreign to someone like us, to this industry that's handling millions of dollars, has so little process in place to vet their members and to make sure that their operators are qualified to do the things that they're doing. And I think the other danger with physicians is we think a lot of people are like us, right? I think there's two groups of physicians. Some are very conservative and risk averse, and others are very trusting. I think we have a subconscious assumption that others are like us, that they think like us, or they have a similar code of conduct, or they have a similar desire to put our interests first, like we put our patients' interests first. We have a duty to act, and we have ethical obligation, and we have some as maybe underlying or subconscious assumption that everyone maybe operates that way. We think maybe lawyers, CPAs, financial planners, real estate operators, maybe they all kind of are like us, but the sad news is they're not really like us. And I'm not saying that all physicians are good, and there's certainly immoral physicians and unethical people in the medical field. And there are people with poor skills in the medical field. That happens in every profession. But there is still some sort of general sense that we're going to behave a certain way. And I think that that doesn't exist in the financial space or the real estate space for that matter. And so it's really up to us. It's up to us as a limited partner. And I think it's especially for physicians because we do get approached quite a bit to invest or raise capital. And we have to be very careful and really vet the people that we are working with. And I know that it's very cumbersome and complicated and expensive. And that's why I'm creating systems for the doctor investor so that we have a process and we can collectively take advantage of this due diligence. Another mistake I see investors make is not spending enough time understanding the market, because the market is very local and it can be very nuanced. I mean, I'm sure wherever you live in your neighborhood, if you go 5 blocks one way or 5 blocks the other way, it can change a lot. And that dollar per square foot can make a huge difference in a deal. So you've got to understand the dynamics of the market. And if you're not familiar with that area, I would not invest in that area personally. I think that a lot of times people hear like a city, maybe Atlanta or Indianapolis, and they think, oh wow, that's great, Indianapolis is booming or Atlanta is booming and it should be fine. But when you actually go into that city and you actually visit the neighborhoods, they're all very different. I mean, even like in Dallas, Texas is a great market, and Dallas is a great market, but within Dallas, there are areas that are not so great markets, right? There are probably areas that are below average and areas that are above average, and only someone who has spent time in that local market would know that. And that is why when you're investing with a sponsor, you want to know which markets they work in and how long they've been there, because that is also going to affect their ability to access the best deals and get the best financing, and also relationships with the city planners and development committees is going to make a huge difference in what they can achieve and how fast they can achieve it. I get a lot of deals from a lot of different areas, and I know, like for instance, the Midwest is a really great area to invest in. However, I'm not familiar with it, and the time and energy it would take for me to really learn about that market really makes it prohibitive. And I don't have a lot of contacts or people there that I can really reach out to. So I just don't invest in those because they may be great deals, but I don't have enough knowledge of that market to invest my money, or especially my investors' money, in that market. And I might be missing out, but that's okay because we can't be everywhere at once. You know, we have to learn about things in a stepwise fashion. I invest in Texas because it's someplace that I live and I can go visit the properties. I can meet the real estate developers and other people involved on a regular basis. And so I feel more comfortable raising capital for something in Texas. And obviously at the end, we've got to look at the deal. Of course, that's what we're all, really here to do, right? But we've got to have those other pieces in place. We've got to know the sponsor really well. We've got to understand that market, and then you can look at the deal. And the deal obviously has a lot of other features as well, which we can get into in more detail in subsequent videos. So the three main things you need to know when you're looking at the deal is the IRR, the hold period, and the minimum investment. Those are some of the, there are other metrics you can look at, but that would be the first three that you really need to know. The IRR is the internal rate of return, which is similar to annualized rate of return, but it takes into account the time value of money. How much is your investment going to appreciate over the time that you are invested? And then you'll need to know, what is the hold period? How long are they going to hold your money? Is it 2 years, 3 years, 5 years? And that can be variable. That is up to the sponsor again. So it could last longer. If the market's down and they want to hold the property longer before they sell, they can do that. And then you want to know, what's the minimum investment? How much do you have to invest to be in the deal? Usually it's around $50,000, can be higher sometimes, but that's typical for a syndication. You'll also want to know, how is the profit going to be shared? What is the preferred return, if there is one, which is the return that the investors or limited partners will get before the sponsor gets any money. So if there's a 7 or 8% preferred return, the limited partners must be paid that 7 or 8% before the sponsor or general partner makes any money. And then you'll have a profit split at the end, which is usually at the exit when they sell the property, usually at 5-7 years. And then you'll have a distribution of the returns from the sale. When you are evaluating commercial real estate investments, what do you got to do first? First, you got to check the sponsor. Sponsor is the most important person in the whole deal. And then you got to look at the market. Make sure you understand the market. Don't invest in markets that you don't understand. And then make sure you understand the deal. Don't invest in deals that are too complicated and have these complex waterfalls and different things that don't make any sense to you, because you should be able to understand it. If it's not making sense, then don't invest. So that's all for today. Thanks for listening, and I'll see you next time.